So welcome back from the breakout rooms and the break. So we will have a look at the mount exercise. As you can see on page 136, here you have the facts and circumstances. We have Mount 60% that acquired, Mount acquired 60% of the share capital. Total shares were 200 million, purchase price 900 million, net assets 800, and there was a stock quote of each share that is offered there at 5 euros. So we have a market price for those shares. Then at the year end, we have some more information here about the net assets that changed from 800 in the beginning. So from the time when the acquisition took place to the year end. So there was an increase in net assets of 150, and another information that goodwill has been impaired by 100 million. So we were required to do evaluation of NCI, and we know there are two methods. One is the fair value method, when we take information from a fair value like a stock exchange, or if we don't have that information or we don't want to use that information because IFRS allows us to do so, we would calculate the NCI based on the net assets at fair value at the acquisition date. So if we do that, then the first answer would be, well, we have to calculate goodwill. So goodwill, oh, it is still there. So please, this should not read NCI at fair value. It should read calculation of goodwill. So it should not read, I'm sorry, I thought I corrected that one, but I don't know why. All right, so please just put there goodwill, calculation of goodwill, because that is what the slide is about. Well, it says calculation of goodwill, at least in the header. So I think we started calculating the fair value of the NCI. So the non-controlling interest, when we look at the stock exchange, they are valued per share at 5. So we will take 200 million, which is the total number of shares outstanding, and multiply that with 40%, which is the share of the non-controlling interest. And when we do that, we have a total of $400 million, which is the fair value of NCI at acquisition date. All right, so we have the fair value of the non-controlling shareholders. So what is the value of the controlling shareholders? Well, there is a market transaction because the parents bought that 60% at the market price. That's what we assume. That is the value of not the stock exchange, but they paid 900 million for that, including a premium for the goodwill. So that is what they paid for 60%. And we have the value for the non-controlling interests. So we have the value for 100% of the shareholders being 1.3 million. And then we can deduct 100% of the net assets. So these two numbers have the same relationship. They relate to 100% of either net assets or assets. And well, then we deduct this 800 from the 1300, and we will have a full goodwill at acquisition attributable to the parent 60% and to the non-controlling interest 40%. Now, why will we call this full goodwill? Well, the full goodwill includes a portion for the NCI, whereas a normal goodwill or a partial goodwill, we will not use that term in practice, we just call it goodwill, but I think more precise word would be partial goodwill. So the partial goodwill only relates to the parent. So full goodwill includes market information, and it is relating to both parent and NCI. So when we have a full goodwill at acquisition of 500, then we learn from the facts and circumstances that there was a loss impairment during the current year. So obviously that was after the company was acquired. So it refers to the post-acquisition period of the company. And therefore, the full goodwill will be decreased by 100 million to 400 million. Now we have a full goodwill, so it relates to both parents and NCI. So we have to allocate the losses of 100 million to the two groups of shareholders. So therefore, we would attribute 60% or allocate 60% of the loss to the parents. So put that in retained earnings of the parents. And we would put 40% in the NCIs. So at the year end, we will reflect those in the group accounts. All right, so that was the calculation of goodwill. Now we go to the non-controlling interest. Well, we concluded that at the acquisition, the fair value of the non-controlling interest was 400. So let's go back to the calculation, which is here. We said that the fair value of the NCI based on the market is 400 million. So we start with this acquisition. Oops, sorry. So we start with this acquisition, we start with this fair value at acquisition, 400. Well, then we have a post-acquisition period during which the net assets increased by 150 million. That was in the facts and circumstances. When you look, well, a little bit hidden, I know. So some of you got stuck. But I think with a little help of your friend, that's me, you understood that, well, if there is an increase of net assets, well, what does that mean? At the acquisition date, the net assets are 800 million, and maybe half a year later, they are 950. So obviously, the company made a profit, and the difference is 150. So you could say, well, there is an increase in net assets of 150, but you could also say, well, there is a profit of 150 million during that period. So what will we have to do? Well, we have to add that share of the non-controlling shareholders of 150 million times 40, which is 60 million. We have to add that to the to NCI. And when they get the money, when the dividend is paid to the NCI, that amount, of course, will be deducted from that amount. But when you set up the accounting, then this sum has not been paid. So the profit will be increasing the fair value of the non-controlling interests. So we have 460. Well, then bad things happen and the goodwill has to be impaired. Therefore, they will, because we are in a full goodwill situation, therefore, the NCI will get their fair share of that impairment. Okay, so what will be done in the end? 40% of that 100 million impairment charges will be accounted for in the NCI account, and therefore decreasing, 40% of 100 will be decreasing the fair value of the non-controlling interest. And if you make the math, then at the year end, you have a total fair value of 420 for the non-controlling interests. All right, so there is something in chat. Okay, so that does not relate to the question here. So do you have questions? No, if not, well, then let's look at AC. So AC was the question, what are the retained earnings for the parents or for the majority shareholders? Well, they start with a retained earnings at acquisition date of 500. Then we have to do the same thing as we did for NCI. We will look at the post-acquisition profit. Remember, that was the difference between net assets of 950 minus 800. Well, we have to consider a share of the parent of 60%. So 60% of 150 equals 90 million. So they will get their fair share of the profits. So that will increase their retained earnings. I think that is clear. And also the other thing is clear when we have a goodwill impairment charge and the full goodwill is impaired, not only the parent gets the full amount, but both shareholder groups, the parent shareholders will get 60% and the NCI will get 40%, which we already did. So here is the other 60 million that will be debited or subtracted from the parent's retained earnings. So in the end, at the reporting date, the parent retained earnings are 530 million. Question? No, I think that's clear. Now we can do that. The whole calculations we just did in the last three tables, we can do with the next three tables. But here we will not use the fair values of NCI. We will use the proportionate basis for NCIs. So we will just start with a percentage of NCI, which is 40%. We have at the acquisition date, we have the information that net assets are 800 million. They increased to 950. We know that, but we have to consider that later. So at the time of the acquisition, the proportionate net asset of the NCI was 320. All right, so we can do the same as we did before. We take the purchase price of the parent, 900 million. Then we add the fair value of the NCI, which represents the other 40% of the shareholders. So we have with the parent 60%, which is 900 million, and 40% of the remaining shareholders, they have a value of 320. So we have a fair value for the net assets of the total company, which is in this case, when we use as a base the net assets rather than market information like a stock exchange price, we now have 1,220. And when we deduct the 100% of the net assets of the subsidiary, then we have a goodwill at acquisition. So please note that we will call this goodwill only goodwill, or what was it? Apportionate. Sorry, I forgot that word. I think in the article that was a better word. So it was like partial goodwill. Yeah, I think, yes, partial goodwill. So the partial goodwill that we calculate here now will be attributable to the parent only, because we did not use information that includes a goodwill portion for the NCIs. So in that case, we will calculate a goodwill, which is a premium of what the parents paid for their share, and that is only related to the parent. Now, the goodwill at acquisition will be 420 then. Please note that we will not relate part of it to the NCI. So don't take now 40% of this and put it to NCI. That would be wrong. Okay, so 100% of that goodwill is allocated to the parent. Now, when we have the loss impairment, we are in a partial goodwill method, or goodwill, a normal goodwill method. Then we will allocate the loss impairment only to the parent. So the 100 million go to goodwill, which will be attributed to the parents only. So the goodwill at the year end is 320. So please note the different goodwills. They are not only different in the amount, but also different in the basis to which they will be allocated. All right, so that was AB. When we look at the table for BB, then we would have to we see that it all starts with a non-controlling interest at acquisition. That is the 320 we calculated here. So based on the net assets, we have a fair value of NCI of 320. So that's the starting point. And then, of course, we have a share in post-acquisition profits. Well, it does not matter whether you take the proportionate basis or the fair value basis. There is a right included in the share. So if you own a share, you have the right to participate in the profits of the company. So the post-acquisition profits will go by 40% to the NCI. So that is the same thing as in the fair value method. But here comes the difference. The NCI do not participate in the goodwill impairment charges, because the goodwill is only allocated to the parent. So they cannot participate in that impairment. And therefore, you will see a zero here, because all of the loss was allocated to the parents. And then we will look at the parent retained earnings. So the parents' retained earnings are 500 million in the start. We saw that from the facts and circumstances. Then they get this post-acquisition profit share, which is 60% of 150 million, 90. And Now here you see that the parents will get the full impairment charge of 100 million, 100% of that, and that will be debited or credited from their retained earnings. So in the end, at the reporting date, the parents' retained earnings are 490 million. That was rather complicated. No, it wasn't. But you have to consider a lot of facts. But I think once you understand the difference between a full goodwill and a partial goodwill method, I think you can figure out what are the consequences. And I think if you try to understand rather than just learning that by heart, I think then you are safe in the exam and also in your career to always take the right numbers. Okay, so no questions. Then what are our key messages? Well, the group accounts may look different depending on the method of measuring non-controlling interests at acquisition. So maybe you will have a look, or we should have a look in the Daimler and in the Wienermilch accounts, whether they base the fair value for the non-controlling interests on the full goodwill or on the partial goodwill method. So please keep that in mind. So it's a difference whether they base their NCI value on a fair value basis or on a proportionate basis. So if measured on a fair value basis, then we end up in a full goodwill, and that will be allocated to both the parent and NCI. Any impairment charge will then be shared by the parent and also the minorities in the same way. They share profits and loss. But if you are measuring, and we learned from that paper that nearly 70% use this method. So if measured on a proportionate basis, then the resulting goodwill will be allocated to the parent only, and any impairment charge will completely borne, so will completely allocated to the parent, and it has been borne by them. All right. All right. So if you're agreeing with me, then we would look at the next chapter, which is the purchase price allocation. Well, what have we done so far? Let's have a look. Well, first, we found out what is the fair value of the investment, which we have to allocate in a single financial statements to the parent. Then we tried to find out what are the net assets, and we could allocate a fair share of these net assets to the non-controlling interests. Then we were figuring out what are the fair values of the assets and liabilities of the subsidiary, and we transformed the single financial statement, the local financial statements, into financial statements that are valued at fair value. And that is the thing where we are now looking at. We have the purchase price of the company, and we will allocate the total purchase price on all the assets that we have and all the liabilities that we have acquired in that transaction. So that's what this chapter is about. Okay, So that is just what I said. So we looked at the parent, what did they pay? We looked at the consideration that was measured at fair value. Then we looked at the situation, what if the parent did not pay 100% of the shares? Well, we found out that there is a non-controlling interest, which also should be valued at fair value. And now in the following, we will look at what the parent gets. So far we looked at what did they pay. And now we will look at what do they get. So IFRS 3 paragraph 18 requires that the acquirer, which is the investor or the parent, shall measure all identifiable assets acquired and the liabilities assumed at their acquisition date fair values. So the overall question is, well, what does an investor do? What does he have to pay when he or she, when the company would make an asset deal? So if you have an asset deal, you would rather buy single assets and take over single liabilities, like you would go into a store and buy all these things that there are in the company again. So you go to a store and then you buy a machine, you buy a building, you buy a car and things like that. So what would you do as an investor? Obviously, you would take that price, what you pay, which is the fair value, you would take that and account for the assets with the fair value. So when you do not go to a shop and buy these things on a asset by asset basis or liability by liability basis, you just go to a company and say, I will acquire all the things you have. But I'm not going to buy all the single things, I'm going to buy the shares. So the investor is buying a bunch of assets and assumes a bunch of liabilities within one transaction. So why would we account for these two things differently? And that is what IFRS 3 is about. They say it does not matter if you have an asset deal or you have a share deal. You will account for that kind of a transaction the same way. So in practice, if there are differences in contracts, so one contract could just say that we will buy these and these and these assets and assume this and this and this liability, and well, the total would be this and this as a price. And there are other contracts that are based on a share deal, so they will just buy the shares of the company. And via buying the shares of the company, they will get control over the assets and liabilities, right? So from an economic perspective, there is no difference. So assets deals and share deals are accounted for the same way. And no surprise, assets and liabilities are also measured at fair value. And that is called the acquisition method, which IFRS 3 requires for transactions to take place. All of the transactions should be measured at fair value. Okay, so in practice, it's easy. We look at this one here. So we have what are we doing during a purchase price allocation? As of the acquisition date, the investor allocates the purchase price to the assets acquired and liabilities assumed at fair values. So what happens in practice is you buy a company, let's say 100%, you pay a certain purchase price, then you look at the book values of these and throw them away because these are not relevant. For instance, if you have land sitting in a balance sheet of the investee, it was purchased long time ago at a very low price. And reality is that prices increase. So when you look at the cost of land 30 years ago, I think you would be lucky if you had bought a lot of land at those low prices and now could sell those at the market price that is quite higher today. So we don't look at book values. That is why we will look at fair values. So we will look at all the assets, and well, we look at the company's books. We see that there are tangibles of 100, intangibles of 250, inventory of 300, receivables of 130, and cash of 120. And when we add up all these numbers, then we come to a total of 900. So that is the fair value. See that I put a FV here that stands for fair value. All the assets are valued at fair value. This has nothing to do with the book values that the investee has in its financial statements. So we don't look at that. We would rather use that as a list of what is there and what should be there and what should be valued at fair value. But what happens in practice is that they would use an expert, and that expert, and I have seen that a lot of times, runs through the company, has the list of what should be there, and then he has a sort of dictaphone, and then he says, "Oh, I see a laptop here. This is maybe the identification number is 123. The laptop is in good shape, and I think that this laptop should be valued at $100. Okay, I see a screen here, the web ID number 2345, and so on. Yeah? So you can imagine how that works. And in the end, this expert comes up with the value for these assets. Same thing with liabilities. So they have long-term loans valued at a fair value of 80, provisions, accruals, other liabilities, and so on. So we have a total of 500 liabilities. So when we compare that, then we have 900 assets, and we have liabilities of 500, both at fair value. Now, what did the company pay? Well, they paid in cash 300, they issued shares of 200, and they had some deferred consideration, not to make it too complicated. So all in all, the purchase price is 600. And again, that is also a fair value because you would also value those considerations at fair value. Now, when you compare these, you have a purchase price of 600, net assets of 400. So this column here will represent the net assets of assets minus liabilities. So you can now see the goodwill, which is the purchase price, 600 minus net assets of 400 equals 200 goodwill. Okay, so that is what you do. You will allocate the purchase price to the various assets and liabilities. And when there is a difference, that will go to goodwill. All right. So basically, when we are talking about purchase price allocation in practice, we will take the consideration that the investor paid, and then allocate those that purchase price to assets and liabilities. And if that is the exact number, so the purchase price is just assets minus liabilities at fair value, then we will not have a goodwill. If they paid less than net assets, well, we have a bad will and have to find out whether it is a lucky buy or not. And I think that's about it when it comes to a business combination, what you will have to do in practice. On the other hand, it can be very, very long list. So when I started in as an accountant in Piet Marwick in 1984, I was at that time maybe one of very few accountants that knew something about Multiplan, which is the predecessor of Excel. So I knew how to use Excel at that time, so in 1984. And my first task was to allocate the purchase price again and again and again on various assets and liabilities. And then the managing partner who had that engagement, he came to me and said, well, can you change, for instance, the tangibles? We think that the use of life, the remaining use of life, is not 5 as we have originally thought. Maybe it's only 4. So the fair value, of course, would be distributed not to 5 years, but only to 4 years. And I set up a big table in Excel. And we did a lot of, change this and change that. And so in the end, the customer, the client, was happy because they had what they wanted. They had the purchase allocation, and they had the consequences of what would happen in the next years according to the depreciation. Because the higher you put the fair value to tangibles, well, those will, if it's not land, will be depreciated over the next 10, 20 years. When you put it to inventory, when you put fair values, hidden reserves to inventory, then it will remove during the next 12 period because inventory is sold very, very quickly. So it is a big difference where you would allocate that purchase price. So I think that is one of the most complicated and one of the most interesting tasks you could see in practice, because you can mess around with the numbers quite a lot. But of course, on an intelligent assumptions, which you should back up by evidence, right? All right, so that's about purchase price allocation in practice. And I think that picture pretty much shows you how that works. All right, so the question always is in this kind of purchase price allocation, do we really have all the assets that there were? And do we really have all the provisions and loans and liabilities? So remember, if there is a restructuring problem in the company, so the provisions should include also the restructuring cost, the restructuring provisions that the investee did not include in their books. So provisions is always, and accruals are always things where you should look very close to, because there might be some things not included in here. Same thing with intangibles. So are all intangibles included in the calculation of the total asset? Because what happens if not? So what happens if assets or liabilities are not complete? So what is the result? Can you put that in chat for me? So what do you think? So if we forget some tangibles or some intangibles, if we forget some provisions, what would be the consequence of that? Yes, there is a very easy answer, and you're right. So too much would be allocated into goodwill. Yes, if you forget some tangibles, so like an intangible, a patent that has a value, a fair value, but was not included in this, then this difference would go into goodwill. So if there are tangibles not included in this list, that would increase goodwill. So what will happen if you forget some provisions that should be there? So can you think of the consequence when you forget some expenses? Well, we saw that when you forget assets, well, that will go into goodwill. So what happens if you forget some provisions? Well, you just have to switch the sign, right? So goodwill will be decreased instead of increased. So that would mean that we will forget about some goodwill that there is if we forget about some provisions. So too much would be allocated to goodwill. That would be the correct answer. All right, so the main problem is accruals and of course intangible assets. When a business combination is performed, IFRS says that all identifiable assets have to be accounted for. And that includes intangible assets, even if they had not been capitalized in the financial statements of the investee. Okay, and that is the problem if you don't book something. So if you don't capitalize a patent that they were working on, then how do you know that there is something out there? So that is the biggest question, the biggest problem, to identify intangible assets that are not physically there. A patent is not sitting on a shelf. Now the patent is a right to manufacture something, to sell something. So it's not visible, and therefore it might be a problem to identify these assets, and therefore that is one of the problems in a purchase price allocation, because we have to allocate the purchase price to all. There is a big stress on all assets. But if we don't identify patterns that are sitting nowhere in the shelf, then we have a problem. And this includes intangible. Yeah, okay, I have read that out. So we have to distinguish between intangible assets booked by the subsidiary before the acquisition. That's easy. We can see, there is something sitting in the intangible asset section, at least in the books. And then we can revalue that item into the fair value. So we will change the book value to a fair value. But what about intangible assets that are not recorded by the subsidiary? And that is the problem. And you were right, when we forget some identifiable intangible asset, that would increase goodwill. And at the acquisition, we also have to look at deferred taxes based on the purchase price allocation, because now we have different book value, and the different book value, which is at fair value, there will be a bigger difference between that allocated value and the tax value, because most tax books that I know work, or tax laws work like that, you will not account for the transfer. You will not allocate purchase prices to the assets, so they will stay the same, and they will keep with the book values of those things, even in the tax books. So if you put higher values to the assets in your consolidated financial statements, the difference between book value and tax value will increase, and therefore you have to reflect higher deferred taxes. All right. So how we still have 35 minutes. Shall we do this one? Are you still? Yes, so somebody is having sudden family works, so of course you can leave. That should be more important than my class. You can always go back to the video. On the other hand, we could also decide to call it a day here. So are you still mentally clear? Do you want to go on? Or who wants to finish now? May I see some hands? Okay, one for staying, two for staying. Okay, so I think, well, we should have reached 150. We are now at 154. So I think we all did a good job, including you. And well, I think we should call it a day for today. I will make a summary, Paul, for tomorrow morning. So please be punctual. Of course, that tomorrow morning will be late afternoon for you. So it is, tomorrow will be Friday. So we will be meeting again at 5:30. Yeah, so don't be too early, then you miss your German class. All right, if you have questions, please send me an email. If you think I should do something different from what I do right now, I'm always interested in whether you like my course or you do not like my course. So please give me the chance to improve it. So just send me an email, and I will really appreciate your comments. So okay, I think there is nothing in chat, so we will call it a day. And thank you very much for listening and participating. It really makes fun to work with you, and see you tomorrow late in the evening. Okay, so bye-bye for now and see you tomorrow.